Would you rather have $100 today or $100 1 year from now? If you said today, congratulations, you already understand the most fundamental principle in all of finance. A dollar today is worth more than a dollar tomorrow. This is the time value of money. It's the foundation of every financial decision, from mortgages to retirement planning to corporate investment. But why is money today worth more? 3 reasons. First, opportunity cost. Money in hand can be invested right now. Second, inflation erodes purchasing power over time. Third, the future is uncertain. A promise of money later carries risk. Think of it this way. If you invest $100 today at 7%, in 1 year you'll have $107. So $100 today and $107 next year are financially equivalent. This brings us to our first formula, future value. FV equals PV times 1 plus R raised to the power n. PV is present value. Money today. R is the interest rate. N is the number of periods. This formula captures the magic of compound interest. Your money earns returns, and those returns, and those returns. It's exponential growth, slow at first, then explosive. Let's see this in action. Invest $1,000 at 7% annually. After 10 years, you have about $1,967, almost double. After 20 years, $3,870, and after 30 years, over $7,600. Your original $1,000 turned into $7,600, and $6,600 of that is pure compound growth. The curve gets steeper over time. That's the power of compounding working for you. Now let's flip the question. If you need $10,000 in 10 years, how much do you need to invest today? This is present value, the reverse of future value. PV equals FV divided by 1 plus R raised to the power n. We call this process discounting. We're shrinking future dollars back to their equivalent value today. Watch how discounting works. $1,000 5 years from now at a 7% discount rate is worth only $713 today. At 10 years, just $508. And at 30 years, only $131. The further into the future, the less it's worth today. Higher discount rates shrink future value even faster. At 3%, $1,000 in 30 years is worth $412. At 7%, $101. At 12%, just $33. The discount rate matters enormously. Now, let's combine these ideas into one of the most powerful tools in finance. Net present value, or NPV. When evaluating an investment, you discount all future cash flows back to today, subtract the initial cost, and if the result is positive, the investment creates value. Here's an example. You invest $5,000 today and receive cash flows of $1,500, $2,000, $2,000, $2,000, and $1,500 over 4 years. At a 10% discount rate, those cash flows are worth $5,360 in today's dollars. The NPV is positive $360. This investment creates value. Choosing the right discount rate is crucial. For a risk-free investment, use the treasury rate. For a corporation, use its cost of capital. For a risky venture, use a higher rate. The riskier the cash flows, the higher the discount rate. What about regular payments, like mortgage installments or retirement contributions? These are annuities. The present value of an annuity equals the payment times 1 minus 1 plus R to the negative n, all divided by R. Here's a practical example. You can afford $1,500 per month on a mortgage at 6% for 30 years. Using the annuity formula, you can borrow up to $250,107. That's TVM turning monthly payments into a home purchase price. One more powerful shortcut. The rule of 72. To estimate how long it takes to double your money, divide 72 by the interest rate. At 6%, it takes about 12 years. At 9%, roughly 8 years. At 12%, just 6 years. Don't forget inflation. If your investments earn 7% but inflation is 3%, your real return is only about 4%. Always think in real terms. Nominal gains can be deceiving. So, what are the key takeaways? First, a dollar today is always worth more than a dollar tomorrow. Second, future value grows exponentially thanks to compounding. Third, present value discounts future cash flows. The further out, the less they're worth today. And fourth, NPV tells you whether an investment creates or destroys value. The time value of money isn't just a formula, it's a way of thinking. Every financial decision you'll ever make comes back to this. What is a future cash flow worth right now? Master this concept, and you hold the key to understanding all of finance.